All right, what's up, everybody? The S&P 500 has sold off pretty significantly here, coming down to its 200-day moving average recently. So that begs us with the question of, what's been driving that, and a lot of it has to do with tariffs. If we take a look at the percentage and the number of companies citing tariffs on their earning calls, we're hitting 10-year highs on that. And so this does present us with some opportunities when we look at the forward PE ratios of the different S&P 500 sectors. We've seen them come down a lot. So a lot of people that were saying that the stock market was expensive, it's gotten cheaper, quote unquote. Now, what we're going to do specifically is we're going to look at the 5-year and 10-year averages for all the different sectors and see which ones are trading below or near those different averages, because that can present some opportunities potentially, right? So we're going to do that. It's going to be pretty simple, efficient, effective. We're going to take a look at where money's been flowing in, where's money been flowing out of. We can see that via this, indicator that we have on our Thinkorswim. We'll also take a look at the performance of the Mag 7 versus the stock market. It's at a critical level right here. This chart alone right here is going to have a big impact on what the stock market's going to do over the next week or two. And then when you take a look at the equal weight versus the market cap weighted, breaking out right here. So we'll see if this leadership will last that we're seeing from the equal weight versus the market cap weighted. And then we've also got some other charts here, just some updates on some different ratio pairs, just kind of highlighting the rotation that we've been seeing in the market. The first one here is the XLI XLK breaking out of this trend line right here. Nice base formation. This is industrials versus tech. We mentioned this in the investment intelligence newsletter that we published last weekend, that this was, one of the areas to look for, potentially seeing industrials outperforming technology. We also have bonds outperforming semiconductors right here. That's a pretty big deal. We saw the breakout. We're seeing continuation of that breakout. And if this continues to happen, that could be more further downside for the market. This is basically showing that things are risk off versus risk on. And again, we have the RSP SPY. This was the base breakout we were looking for. We did get that base breakout. And, when we're looking at the other chart, we're looking to see if we're going to get potential continuation of a longer term trend line breakout. Now, what we're also going to do in today's video is break down the sector returns, okay? So the price return is basically the EPS growth plus the PE multiple growth right here. Okay, so we'll break that down for each sector. We'll take a look at the equal weight versus market cap weighted, right? And then we'll look at how many stocks are outperforming the S&P 500 within those sectors. We'll compare the current PE ratios to historical averages, and then we'll take a look at the S&P 500 earning estimates, year over year, quarterly here as well. All right. But as always, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So be sure to read through the disclaimer. And I did start a completely free newsletter for you guys. I mentioned it earlier. It's called Investment Intelligence. I give out free, valuable finance and trading related content, and I even sprinkle in free trade ideas in there as well. Really high quality setups, how to find and spot those high quality setups, different rotations, warning signs in the market, charts, different things like that that I'm looking at. I think you guys will enjoy it a lot. So sign up for that. There's a website. You can check out all the articles, read some of the previous ones before you dive into it, see if it's something that you guys want sent directly to your email inbox. And if you do want to join the private trading group, promo code Powell will get you guys 50% off your first 2 months. So that's a pretty nice discount right there. Inside, you'll get 20 plus swing trade ideas every week, custom scripts and indicators, exclusive chart layouts, and much more. Right now, here is our SPY chart. Okay, so I mean, really nothing to panic about in my book. Okay, we have a nice clean base right here. Base formation, base breakout, comes up, hits our Fibonacci target. We, overshoot it a little bit, create some overhead supply, retest that overhead supply, and we came down here recently and retested that prior supply, prior resistance, and we did bounce, right? We did bounce from that area. So that's a good look for the market, right? And we're going to see, what happens from here, right? If we continue to hold above this zone, or if we end up, perhaps causing a liquidity sweep below, or if we break down, retest, and continue heading lower, right? That's what I mean about 560 to about 565. is a really critical zone, and I want to see where the stock market is trading, a month from now, 2 months from now, in relationship to that level right here. Are we going to be able to consolidate and start rising back towards all-time highs? Or, as I mentioned, do we break and retest this area and start heading lower, potentially down to the 540s? So that's what I'll be watching from the broader market. But in terms of forward PE ratios, we've got the S&P 500 for forward PE ratio right here on the left. Okay. That's what this one is. You can see the 5-year average is basically 20. The 10-year average is 18.4, and we're at 20.8 right now. So we are slightly elevated. Last time we were below the 5-year average was in summer of 2024. And that was a really good buying opportunity, right? That was a good buy the dip opportunity last summer. And this chart is just showing that potentially we could be getting back down towards those levels in the S&P 500. Technology forward PE ratios is at the lowest levels that we've seen in a year, essentially. The 5-year average is 25.4. We're at 25.9 times. So, if this starts trading below, you could be scooping up the technology sector or some stocks within the technology sector, well below their historical averages. And that's what you want to do, right? Is you want to find what you think is value, and quality companies, blue chips perhaps, and get them, at a historical discount. That way, when things go back above and they get frothy, then perhaps you can look at trimming and taking some of those profits, right? Financials have been one of the strongest sectors of the market this year, trading, well above their 5-year average of 14.3 and their 10-year average of 13.7. They're at 16.4 right now. Consumer discretionary, all right, and largely this sell-off is driven by Tesla. The consumer discretionary sector is, mostly Amazon and Tesla. And we can see that this is trading well below its 5-year average of 28 and just above its 10-year average of 24 times, right? It's currently at 25.3. So this is an area of the market that I'm really looking at, right? I've been buying some Tesla shares on this pullback. And, as I mentioned, Tesla and Amazon shares too, I've been grabbing some of those. That's just an area that I'm pretty interested right now, and it's almost below, or it's almost at those 10-year averages. Now, healthcare was one, this one saw a lot of pain, right? Everybody kind of knows what happened with United Healthcare CEO. And that kind of just sparked, further downside and really accelerated the downside movement in that overall sector. And it was trading below its 5-year average at the end of the last year and early, heading into this year, which is 17 times. The 10-year average is 16.4, and it's right around 18 times right now. So if we do see healthcare start to pull back, this is some stuff that you can start looking to start making, quote unquote, a shopping list, right? Or get a shopping cart, right? You're looking at these PE ratios and you're saying, okay, well, which ones are close to some averages or trading below some of those averages? Make you a list of ones that you're interested in, and look to see if you can get them at those prices and those valuations that you're looking for. Communication services is trading just above its 5-year average at 18.9. And the 10-year average is 16.5. It's at 19.1 right now. So just barely above, right? Then we've got industrials right here trading at 22 times. Their 5-year average is 20.8, 10-year average is 18.7. Consumer staples are trading up here at 22 times. Their 5-year average is 20 times, 20.3, and the 10-year average is 19.8. So this one's trading well above right now. Energy is trading below both its 10-year and 5-year average at 14 times. The 5-year average is 16.4, and the 10-year average is 21.1. Utilities are trading still below their 5-year and their 10-year average right now, currently at the moment, even after the very strong rally in the strong year that they had last year. They did pretty well. But we're still seeing them trading below their 5 and 10-year averages. And it's at 17.2 right now. The 10-year average is 17.6, and the 5-year average is 18 times. So, this is an area where you can potentially look at. All right. We have materials. Okay. And we'll talk about materials a little bit more in a second, why I think that there could be more potential downside in materials. But the materials are at 20.9 times. The 5-year average is 18.3 and the 10-year average is 17.5. And then real estate is trading below its 5 and 10-year average at 19.6 times right now. Now, the reason I was speaking of materials is because if you look at the number of S&P 500 companies citing tariffs on their earning calls, it's at 10-year highs, right? We're seeing an extremely large amount relative to what we've seen in the past when it comes to companies citing tariffs. And if you look at the percentage of S&P 500 companies citing tariffs on their earning calls, materials is 82%, right? So 82% of those companies in the material sector are citing tariffs and basically expressing concern and their own thoughts and opinions on tariffs. And when we look at materials forward PE ratio, it's trading very well above its 5-year and 10-year averages. So, no guarantees, but if tariffs are going to have a negative impact on the market, um, and we get more tariffs because right now it's just a lot of back and forth. Bringing tariffs on, taking them off, and then bringing them back on, and then bringing them off, and then oh no, they are real this time. And there's a lot going on there, so it's a lot of noise. It can be very tough to navigate and trade through, which is why we're doing today's video and just kind of zooming out, taking a look at some of the PE ratios, trying to find areas and sectors that we believe have value as the S&P 500 is pulling back and pulled back towards its 200-day moving average. Now, what we're looking at this chart right here. Okay, we've got money flows in at the top, money flows out at the bottom. So if a line is trending downwards, it means money's flowing out. If a line is trending upwards, it means money's flowing in, right? And what do we see? We see technology, lots of money flowing out of technology. Technology is a very big weighting in the S&P 500 and has largely had, or has had a large impact on this downside move that we've seen in the stock market. So not much of a surprise, but my thoughts and opinions on that are if people have been in these technology stocks for the past 2, 3 years, they're sitting on some pretty significant gains, right? We just had two back-to-back, really impressive years for the stock market and, for technology as well. So money flowing out of there doesn't have to mean the end of the world, right? I mean, there's a lot of people sitting on some profits and, tariffs and whatever fears about the economy are a pretty good reason for people to justify taking some profit and perhaps putting that money and rotating into other sectors, other areas that aren't at such stretched out valuations. Right. But yeah, we see utilities, materials, industrial staples, energy, healthcare, financial cyclicals, pretty much everything else is where money has been flowing into as it's been flowing out of technology, right? And that's really evident in a chart like this. Okay, if you look at the Mag 7 versus the stock market, which is going to be on the top, we can see here that it's just completely rolled over here recently, right? It formed the top, and since then it has just declined rapidly. And now the big question is this a massive top? If this is a massive top right here on this ratio chart in relative terms, and this breaks down and this ends up becoming some type of head and shoulders, right? With a left shoulder head. And, maybe we do something like this, right? And we consolidate around this area, form that right shoulder and break down through here. That's going to cause some significant downside for the market, in my opinion, due to the heavy weighting of the Mag 7 stocks. So we've got, prior resistance, support, and now we're testing it as support again. We've already tested it 3 or 4 times. If this support and this demand falls through, it's going to mean the Mag 7 stocks are underperforming the stock market, and which most likely means that they're selling off more than the stock market is. So that's definitely something to be concerned about and watch. I would definitely watch this ratio here. Now, what that means, okay, and another way to kind of visualize that is that the equal weight is outperforming the market cap weighted. Okay, the market cap weighted S&P 500 does have that really big weighting in those Mag 7 stocks. And we're seeing, those stocks declining, those stocks selling off harder than the rest of the market. And so the equal weight has actually been outperforming, and it's breaking out of a trend line here, a very long trend line, long-term trend line. And we're going to see if this can have continuation. There are periodic bouts, there are periods, okay, where we see basically, some outperformance, but it's short-lived, right? Here, here too, right here, over here. but it never seems to truly last. Okay, so it's not necessarily a great thing if you are looking for this to start, a long-term trend reversal and break out and continue to break out and outperform the market cap weighted for, over a year. Or 6 months or something like that. That usually means that the biggest stocks in the market are selling off, right? And that's going to have a pretty big impact on people's portfolios. Not necessarily the best case, but this is something that you can prepare for. This is something that you can trade or rebalance a portfolio or something like that whenever you see these periods of, okay, well, maybe the equal weight's going to start outperforming the market cap weighted. Maybe I want to adjust some things. Maybe I want to hedge some things. Same thing with this, right? If you're overly exposed to the Mag 7 and this chart breaks down right here, well, then you want to have some type of plan or be prepared for what you're going to do in that scenario and in that case. We're also seeing industrials starting to, put in a base here, potentially breaking out. We're trading just above it, right? So technically we do have a breakout. But in terms of continued performance, we're going to look and monitor this. We talked about how money's been flowing out of tech, right? That's going to be your XLK. And industrials was one of the places that money has been flowing into. And we do have a nice base formation here, right? So if this is breaking out, this means that industrials are outperforming tech. We have TLT divided by SMH right here. This is basically the bond market versus semiconductors. The reason we're looking at this is a very good chart to understand if there's a flight to safety, if there's risk on versus risk off. And we're definitely risk off here at the moment, and there definitely has been more of a flight to safety. Okay, as this chart is breaking out, it means that bonds are outperforming semiconductors. And bonds are pretty volatile for the bonds, in terms of, their volatility on a daily basis or a weekly basis compared to the past, 20, 50 years. But they are not as volatile as something like the SMH, like the semiconductors. Okay, those are very volatile stocks that move 3% a day, 5% a day, 10% a day, sometimes even. And you're really not going to see the bond market moving 10% a day in something like TLT unless something crazy is happening at the moment. So this outperforming semiconductors is just a visualization of risk off. We talked about this in the newsletter, and we had this base, and we are looking to see, as this was breaking out, if we are going to get continuation, and we are doing that. We're consolidating above those base breakout levels. The RSP divided by SPY, RSP is going to be your equal weight. So we looked at a little bit more of a longer term, trend line reversal breakout that's happening. But here we also talked about in the newsletter, just a nice base formation, right? We had a nice, basically double bottom here, breaking through there and potentially going to continue to outperform. If this technical chart pattern wants to play out, then we could continue to see the equal weight outperform the S&P 500 on the short term via this chart, and on the longer term to more intermediate term, that original chart where we're looking at the equal weight versus the market cap weighted. But let's go ahead and break down the S&P 500 sector returns right now. We've got healthcare up the most, okay, up 8.3%. All right, and that's mostly from its multiple growth, okay? Its earnings per share growth was 0.3%, but the PE growth was about 7.9%. Then you've got consumer staples here. Their EPS is actually down 1%, but the PE multiple growth is up 7.2% right here. Real estate coming in third at positive 4.2%, slightly positive on its EPS growth of 0.4%, with the PE multiple growth of 3.7. Then we have materials here. EPS growth down 7%, but the PE multiple growth is up 12%. So, this one's a strange one to me. I'm probably not going to trade it, but just when we were looking at those valuation charts earlier, we saw that it was well above its 5 and 10-year averages. We see that the materials, 80%, I believe it was, of those companies were citing tariffs in their earnings calls. We see EPS growth is, the worst on this chart at negative 7%, but the multiple growth has gone up 12% here. So not too sure what's going on, if what market participants are seeing, what they're factoring in, and why there's such a disparity between the multiple growth and then the earnings per share growth. But that's not something I'm going to try and figure out and try to trade, but just something that I've observed looking through these charts. Then we've got industrials here. EPS growth down 0.3%, multiple growth up 2%, utilities up 1.5% on the year. Their EPS growth 1.2% with multiple growth at 0.3%. Then we've got energy up 1.4%. EPS growth is down negative 0.9%. And then the PE multiple growth is up 2.3%. Then we've got financials up 1.4%. The best earnings growth, right? The best earnings per share growth on this chart is going to be in financials. And the PE multiple growth is actually down 3.3%. Then we've got communication services up 0.1%, with EPS growth up 1.3% and PE multiple growth down 1.1%. Here's the S&P 500 in total. Okay. Year-to-date returns down about 2%, negative 1.9, with earnings per share growth up 1.6%. And then the multiple growth here down 3.4%. And then we've got technology down negative 7.5% on the year. And EPS growth is positive 2.6%, but the multiple growth is down negative 0.8%. And consumer discretionary down 10.6%. A lot of that has to do with Tesla. Its EPS growth is up 1.5%, but the multiple growth is down negative 11.8%. Now, if we take a look at market cap weighted versus equal cap weighted, which ranking tells us the best story, we can just see a little bit of the differences, right? In healthcare, in the cap weighted sectors, healthcare is the top performer. And then when you look at the equal weighted sector, it's the second top performer. So that's pretty good. That's telling you that it's a broad rally in healthcare. It's not just one company that's really driving all of that. Because if it was one company, then perhaps it would look something like this with communication services, right? Where if you take a look at the equal weighted sector, it's up 5%. But if you take a look at the market cap weighted sector, it's up 0.1%. So, there's some stocks in there, some heavily weighted stocks in there that are dragging down the performance of the communication services. But when you zoom out, you can see that broadly, communication services have been doing very well, especially when you look at the equal weighted, it's the top performing sector. Okay, then we've got real estate here coming in third at the cap weighted and coming in fourth at the equal weighted. So those line up with each other pretty well. And then you've got the two worst down here, technology and consumer discretionary, both showing up at the bottom, of this chart here. We've got the market cap weighted S&P 500 down 1.9%, but the equal weighted is actually up 0.6%. So we do have positive returns in the equal weighted sector of the market, of the S&P 500, but the cap weighted is being hurt, you can assume, by technology and consumer discretionary pretty bad here, which is bringing that down. Now, how many stocks are outperforming the S&P 500? Okay, so in gray, you're going to have the percentage of stocks outperforming the sector. So we have the different sectors down here, and then the percentage of stocks outperforming the S&P 500 is going to be in the colors here. So, in technology, only 39%. Okay. And so we've talked about that rotation out of technology. If people are rotating out of it, they're selling it. And that's very clear, right? Less than half of those stocks, less than 40% of those stocks are outperforming the stock market. Okay. 60% of stocks right now are actually outperforming the S&P 500 in total. And so if you think of it this way, about, 40% are underperforming the S&P 500, meaning that, there's some heavily weighted stocks in that 40% that are dragging the S&P down to make it negative on the year-to-date returns. What's interesting here is that the percentage of stocks outperforming the S&P 500 is very, very high in communication services, over 82%, in real estate at 77%, at consumer staples, 76%. This is where a lot of the gains are, being held up in the market, right? And when we take a look at the equal weight and seeing it's up 0.6% on the S&P 500, but the market cap being down so much, a lot of that has to do with technology, consumer discretionary really underperforming. And then you've got sectors like communication services, real estate, consumer staples, really picking up a lot of the slack in the market. We have utilities here. We have healthcare, 70%. That's also very high. And we have energy at 68%. So, a big majority of these different sectors are actually outperforming the S&P 500 about 70%, from 70 to 80% basically we'll call our range here. In communication services, real estate, consumer staples, utilities, healthcare, and energy. So maybe these are some sectors that you want to potentially look for some opportunities because we know that strength tends to lead to strength. Strength doesn't always lead to weakness, okay? Just like weakness doesn't lead to strength. So, if these are the areas year to date where we're seeing strength, it's very possible that that could continue to be a trend for the rest of the year or maybe another quarter or two. And you can go back and revisit some of those valuation charts and take a look at where those sectors are on their historical averages and see if there's any names within those sectors that you're perhaps interested in investing in. We're also going to compare the current PE ratios to historical averages right here. So if we take a look, the percent above their 5-year average PE ratio is in green, and then the percent above the 10-year average PE ratio is in purple here. So the S&P 500 is 5% above its average 5-year PE ratio, and it's 13% above its average 10-year PE ratio. Okay, the only places we're really seeing negative is going to be in consumer discretionary. It's down. It's 10% below its 5-year average. But it's still 6% above its 10-year average, which is pretty interesting there. Utilities are down both on their 5-year and 10-year averages. Real estate is below, its 5 and 10-year averages, and then energy is well below its 5 and 10-year averages. Okay, now some of the ones that are pretty close, if you take a look at communication services, it's only trading 1% above its 5-year average PE ratio. You've got technology only trading 2% above its average, 5-year PE ratio. We talked about, that strength in communication services. So maybe, you can potentially look at some names within this area, maybe look at some names within some of these other areas, going by some of these charts over here, right? Real estate still well below averages, right? And 77% of stocks in the real estate sector are outperforming the S&P 500. Utilities is still below its 5 and 10-year averages. Utilities, you've got 71% of stocks outperforming the S&P 500. And then energy, very well below. All right. And if we take a look at energy, even energy has 68% of stocks outperforming the S&P 500. All right. So when we talk about rotation and get some of these pictures, right? We see that technology still is trading 20% above its 10-year averages. Before the sell-off, we were trading well above its 5-year PE ratios as well. Okay. And this chart is kind of just showing that, we have seen a rotation here recently. And these are some areas here that you can potentially use this chart to help decide, where are some areas you want to look at the market. Now, here's the earnings estimates, the year-over-year change in EPS estimates. What I want to show you guys and basically highlight here is the downward movement. Okay, so notice how the S&P 500 quarterly EPS actuals and estimates, okay, overall this has a pretty positive trend line, right? Upward sloping, right? There are periods where we have, doubts where it goes down a little bit. Okay. But if we take a look at what's happening here, it's going down, right? For Q1 2025, the quarterly EPS estimates are lower. Okay. And so right now we're pricing in lower expectations. All right. It's not great. Okay. And that could be a reason that the market is selling off. If this continues to decline, right, we see it's basically only pricing in one bad quarter and basically no growth for about 2 quarters, right? It's at 65.6 right now. For Q2 2025 EPS estimates, 65.9. So really no growth for the first half of the year is being priced in. But then the back half of the year is when we do see that growth back priced in over here, right? At 70.5 and 72.9. So this is another way to look at it and look at those charts. But here's 2026 EPS estimates. Okay. Here's 2024. Here's 2025. And you can see we do have a little bit of room to come down. 2025 EPS is at 271. We're at 277 right now. And then we've got the S&P 500 quarterly EPS estimates. All right. Currently we're in the Q4 2024. All right. Q1 2025 is down. Q2 2025 is down. Okay. And we talked about that right over here in this chart, 60.7, 65.9. We're at 65.6 right now. So, it's not necessarily down the 65.9, all right, but you can see that it's not pricing in much growth for the second quarter of 2025. They're expecting it to be right around the levels that we're at. And then Q3 and Q4 are when things look good again in terms of estimates at 70.5 and 72.9. All right. Now, if you want access to the private trading group, okay, use that promo code POWEL. There's a link in the description that will get you guys 50% off your first 2 months. Okay. Inside of there, you get plenty of trade ideas, you get custom scripts and indicators. What do I mean by that, right? Well, you may have some questions. Take a look at this here. All right. We featured the Zone Finder trade idea on Bristol Myers when the Zone Finder first came out. That's a custom script and scan and indicator that draws supply and demand zones for you. I know as beginners, one of the big questions that I get a lot is, well, how do you draw demand? How do you draw supply? How do you find it? How do you know which areas to do? So this script right here actually does it for you, right? And it draws those supply and demand zones for you, which is really, really great and takes a lot of the hard work out of it. So, if you want access to something like that, join the Discord, right? Otherwise, you can sign up for the newsletter. That's completely free. There's a website associated with it, so you can go back and, review some of the previous articles and trade ideas on there, see if it's something that you guys like. Thanks for watching, and I'll see you in the next one.